Good afternoon. Thank you for joining me on this webinar. For those of you who don't know me, I'm Chris Trigg. I'm an accountant. I've been working within the energy industry for the last 16 years, initially as a CFO of a retail energy supplier, then head of finance for a solar PV installer, and now I'm the co-founder and MD of Ongen. During this webinar, I'm going to summarize some of the key challenges in the energy market, describe what I mean by the energy transition, and why accountants and other finance professionals within an organization should be fully aware of the risks and the opportunities the energy transition presents. I'll look at some of the practical steps that we can be taking to mitigate these risks and actually benefit the organizations that we represent. So looking at some of the names that I've signed up to the webinar, I think I might be preaching to some of the converted here. But it was striking last week at the CBI's Achieving Net Zero conference that I attended, just how few of the delegation actually came from the finance function of organizations. So what do we mean by the energy transition? In the relatively short time I've been involved in the energy sector, there's been a seismic change in where the UK gets its energy from, particularly electricity. I, like others, have been talking about what's termed the energy trilemma for many years. I think people understand the concept of affordability and sustainability, certainly judging by the number of ESG and net zero experts that have materialized over the last few years. But I think security of supply, despite a number of recent events, notably in August 2019, when we saw a massive prolonged outage across the UK, I'm not sure that the supply is taken that seriously. But of course, all these three elements are interlinked. Now, when I'm talking to organizations about the energy transition, I'm going to look at it from the perspective of the carrot and the stick. My initial focus is on the benefits that can be gained in terms of the cost of energy, in terms of security of supply, and by extension, the volatility of wholesale prices. And these factors in themselves, to some extent, are driving the energy transition, certainly at the moment. But if that carrot is not tempting enough, there is, of course, the stick in the form of increasing legislation and compliance. The overarching piece of legislation that's behind the UK's drive to reduce its greenhouse gas emissions is the Climate Change Act 2008, which followed Kyoto. And that was amended in 2019 by a statutory instrument. Memorably, Theresa May announced in, I think it was August 2019, that the UK was the first developed nation to set, obviously enshrine in legislation, a net zero target by 2050. And that would include a 78% reduction versus 1990 levels by 2035. And the UK government has published a net zero strategy, Build Back Greener, which was in October 21. Now, this revised target has then precipitated a whole range of organizations and trade bodies to declare their own net zero targets. These are some stats that we received from MACE. 86%, for instance, of local authorities have set a net zero target, and 70% are before 2035. So that's not long at all. But only 3% of local authorities are actually delivering against a net zero action plan. The Energy Savings Opportunity Scheme, ESOS, that requires large companies, of which are about 12,000 in the UK, to carry out a mandatory energy assessment, essentially an energy audit, to understand where energy savings could be found. We've already had one compliance period. We're now into the second compliance period, and that will close on the 1st of December 2023. I think ESOS and the streamlined energy and carbon reporting requirements, they're certainly putting the subject of carbon reporting and energy firmly on the boardroom table. And I think it's inevitable that this legislation will be rolled out to smaller companies. But I feel, certainly to begin with, it was maybe seen as a box-ticking exercise rather than a useful exercise for the business to understand where it could save money, could save carbon, and deliver a competitive advantage. It's fair to say we've made some good progress since 1990 against the particularly for the generation of electricity that is entering the grid. And CO2 emissions from electricity generation, certainly in 2018, was 68% below 1990 levels. So what I found surprising as I was researching for this webinar is that whilst between 2020 and 2021, the carbon intensity, the CO2 intensity of electricity fell by 9%, which is pretty consistent with previous years. And that's due to a significant decrease in coal generation and an increase in renewables and nuclear generation since the previous year. Methane actually increased by 11% because there was more incineration entering the grid. And actually, if you look at methane is 80% more potent in terms of a greenhouse gas than CO2. And even just yesterday, there was a big story talking about a massive release of methane from a Russian coal mine, which would have powered hundreds of thousands of homes in the UK. Per the government's energy strategy, which was published in April of this year, nuclear will have a massive gap to fill in terms of base load, but we're probably looking at least sort of 10 to 20 years. I think we've got about 15 nuclear power plants on the grid at the moment. But you can see clearly on the graph that the percentage of nuclear is actually falling and has fallen steadily over the years. But whilst we've seen that, wind and solar has partly filled the gap, and coal has largely disappeared now, but it's still there and it's still needed for certain times of the year. Heating is a much more complex issue, and our reliance on gas, I believe, is set to continue for some time. My bet in the longer term is probably on hydrogen. And in the short term, heat pumps are certainly being incentivized heavily, but I don't think it necessarily touches the sides when you're looking at a manufacturing process that requires a high grade heat. No presentation would be complete without a slide demonstrating just how expensive and volatile wholesale energy prices have become. And whilst that proportion of the total energy bill has fallen in recent years, relative to those third-party charges on the non-commodity costs, such as network charges and environmental levies, these levels have not been seen previously. At one point last winter, natural gas contracts were trading at over 800 pence a therm. And to put that into some sort of perspective, certainly when I was a CFO at the retail supply company, we were balking at 80 pence a therm. We thought that was high. So it's clear, we're not going to get back to cheap gas anytime soon for a number of reasons, not least the war in Europe at the moment. This rather scary graph is further demonstrating the volatility in the wholesale markets. And clearly those current events I've just mentioned are responsible to a very large extent, but also just reflecting back on the previous graph when we looked at how much the wind and solar, the intermittent generation, is now feeding directly into the grid, the balancing and settlement company, Elexon, have got an even bigger job now to ensure the grid is balanced at 50 hertz. And that becomes challenging, which in itself increases electricity costs through higher balancing charges. So just kind of touching back on the heat situation, official data shows that about 8% of our total gas imports in 2021 came from essentially Europe through undersea pipelines or interconnectors. But the European bloc itself relies on Russia for 40% of its own supply. So there is bound to be some kind of knock-on effect as to how much gas can be pumped into the UK. I was at an event 2 days ago, Climate Tech in London, where Greg Hans was speaking, and he was playing down the reliance on Russian gas, which is possibly fair. He was saying that 4% of our gas comes from Russia, and that possibly is true. But during severe winters, of which we've had a couple, the UK's reliance on piped gas has increased. So the so-called beast from the east in 2018 meant Britain received something like 20 or 25% of its gas through the interconnectors. That's a risk. That's a significant risk. Now, National Grid has stressed that the country can source gas from multiple sources, and this is true. And this includes liquefied natural gas, LNG, which is shipped to terminals from places like Qatar. And there are tankers in the oceans out there, probably 40, 50, hundreds of tankers out there. That commodity can be traded multiple times before it reaches its final destination. And quite often it will go to the Far East because the UK is outbid for that supply. So I recognise this as being a significant issue, a significant risk. So why am I hosting this webinar now? Energy has really left the headlines in the last 12 months. And whilst the energy sector, I think particularly the domestic retail sector, has been a political football for many, many years now, energy costs and security of supply and the failure to address net zero are real business risks. I think for too long, finance professionals have seen energy as an inevitable cost category, and look at this year's spend, add 5% for next year's budget. There has to be a better understanding of the risks of doing nothing, and that there are opportunities to improve competitiveness, to improve the bottom line, whilst we're doing the right thing for the planet. Finance professionals have the ability to turn what are often good intentions into meaningful action. Finance professionals, we're decision makers, and this extends to those required when we're looking at how a business or an organization will source its energy requirements. It shouldn't just be the preserver, the procurement manager, the head of energy, head of sustainability, head of estates, head of ESG. It makes sense that finance professionals are involved in this decision-making process because we're used to understanding data. That's what we do. We tend to be analytical thinkers. We need to understand the return on investment, and ultimately funding is required. So, the value for money is in our DNA, particularly those like me who hail from Yorkshire. So what can we do to help organisations that we work for or represent to transition to clean, sustainable energy solutions in a way that also benefits the financial performance of the organisation, both directly in terms of that kind of contribution from a financial perspective, so through energy cost savings, but also from a reputational perspective as part of a kind of corporate social responsibility perspective. I think in a 40-minute presentation, and I probably won't speak for the full 40 minutes, I'd like to get some Q&As at the end of this. There's a limit to what I can cover. Energy efficiency for me is a no-brainer. If you're in the business of, say, letting properties, it's a serious issue. We've got the minimum energy efficiency standards, MEES, and these regulations came in 2018 and require landlords to ensure that they carry out works to improve the energy efficiency of their buildings. So by 2030, we should be looking at an EPC rating, an energy performance certificate rating of B, or risk the penalty in the form of a civil fine or not be able to let out the property in the first place. I know when MEES was launched, 2018, there was an estimate that it would be well over £1 billion to transform buildings that were rated as an F or a G to get to an improved rating. And it was, I think 18% of the building stock was there, was in that category. And, if you look at the sort of 2050 target, 80% of the buildings that exist in 2050, they exist now. So the great news is doing what's right for the planet is also right for doing the right things for the business in terms of bottom line, security of supply, and cost certainty. It's worth noting as well that according to Bayes and Lazard, for instance, the levelized cost of onshore wind, offshore wind, solar is lower than that of all fossil fuels and nuclear for that matter as well. The starting point when building the business case is to recognize what the individual elements are that make up the cost of delivered electricity, and in this particular case, gas. When you start to understand the breakup of the bill, you recognize that approximately 70% of these costs are marginal, i.e. these are unit costs that can be avoided if grid consumption is reduced through maybe using less energy or by generating on site. Now, Ofgem have recently reduced that level of marginal cost that could be avoided easily in terms of the cost of distribution and also through transmission. So there has been a shift in order to ensure the network is paid for from a unit charge to more of a capacity-based charge. That doesn't mean to say that we can't actually reduce, though, some of those capacity charges as well. It may not be quite as easy as just simply not using as much energy or installing on-site renewables, but it is possible to move the property from one banding to another, and some of the savings are huge. And the kinds of technologies that can be used, like battery storage and on-site renewables, can really help to avoid, excess capacity charges. So I believe it's very likely that also that steps may be taken by Ofgem with Bayes to potentially transfer some of the environmental and social levies away from electricity, and they could potentially be attached to gas or other fossil fuels. And I think this might make sense. There's a strong argument at the moment to do that because it would make the economics of investing in heat pumps, for instance, or EVs more attractive. Politically, I think that could be quite a challenge because, as I mentioned earlier, we have this reliance on gas. We're still very much reliant on gas for our heating. So particularly when we get into the winter, transferring what essentially represent, I think, the environmental levies currently within an electricity bill are 25% of the bill, switching that cost to gas, I think will be a very, very tricky political maneuver. So at the heart of the solution is data. And it's the reason why I'm doing what I do now, because when armed with the right sets of data and knowing how they interact, we can identify the most appropriate energy cost and consumption measures that stack up economically and reduce an organization's greenhouse gas emissions. So there was a modification to the Balancing and Settlement Code called P272 and subsequently P322. These modifications were really crucial because it meant that from the 1st of April 2017, those businesses that were being essentially billed or settled on a predefined profile class, and they were classes 5 to 8, they were required to have their energy use measured, recorded through a device such as an AMR, an automatic meter reader, that would record consumption every half hour. So what does this mean? It means loads and loads of data, really valuable data, which shows when electricity is consumed. On top of that, we've now got 18 million plus smart meters. So we've got loads of really great data here. And this kind of feeds into the key principles of how we can tackle the dilemma about the energy trilemma. We're looking at its analysis of data. It's understanding the return on investment. And actually going back to the previous comment about ESOS, the Energy Savings Opportunity Scheme, what it actually has done for many, many companies is actually kind of made that access to data more readily. We had to look at the energy consumption in far more detail for a whole range of organizations. Interestingly, I still find organizations that are metered, they've got a half-hourly meter, and they don't even realize it. They don't recognize that this data even exists for their properties. And so on this slide, I've just highlighted an example meter point administration number. The highlighted number, the 00, tells me and tells the customer that their electricity supply is being recorded every half hour. That's 17,520 bits of very useful information, data that we can use to understand when energy is being used. As you might expect, given Ongen's origins and even the name Ongen, on-site renewables, on-site generation, I'm going to focus on a case study that highlights the financial benefits of two on-site renewable technologies. One is roof-mounted PV, and the other is ground source heat. When thinking about on-site renewables, it's a common mistake to think solar PV, solar photovoltaics, and nothing else. There are other technologies. They could be more suitable, dependent on that energy consumption profile or where the building is located. Or there could be a technology that complements solar PV. So, I've chosen ground source heat, but, a wind turbine could be an option. A battery could be an option. Air source heat could be an option. You could be looking at CHP, combined heat and power, both in terms of biomass and even gas. It still has a role to play potentially, or solar thermal. So I think my message, if nothing else comes across today, my message is to be open about what solution might work. Because I think until you do that analysis, you may well have a good inkling and you may well have a predetermined idea of which properties I should be looking at and which technologies. But I think it's really important not to rule out any option until that analysis has been done. The analysis on this site is in Nottinghamshire, and it uses half-hourly electricity consumption data. And the energy tariff data has then been used to construct essentially a half-hourly tariff matrix. So we understand how much energy is being used and what does it cost when it is needed. And then armed with this data and understanding what the capacity for the roof space in this case is to generate electricity from solar panels, then we can then correlate those two data sets and come up with a sensible system size that will maximize the return on investment. So in this particular case, we can almost look at a quarter of a megawatt of solar PV on sort of south or southeast facing roof space. We've got some estimated costs, and costs are difficult right now because what we're seeing in the market is, because of supply chain issues, the costs that we have expected to fall and have fallen dramatically in the last 20 years, they are beginning to increase. And we've sort of made corrections to some of our numbers and adjustments to recognize, the cost of labor, supply chain issues has actually pushed up the cost of many of the on-site generation options that are available. It's worth noting a few things though. It's possible to generate a return on investment that is maybe a better internal rate of return. But that would come from a smaller system size. This kind of comes back to the fact that what is that client? What are you trying to achieve? What is it? Is it about carbon savings? Is it about to achieve a financial return? Because what you might find is a different size of system will meet a particular investment criteria. Now, in this particular case, the analysis of the solar PV also takes into account the additional electricity that will be required to power a ground source heat pump. And that heat pump would meet almost all of the spatial heating requirements of that particular building. But this particular example actually is a good example of a manufacturing site where they require higher grade heat. And this becomes a greater challenge. It's a much more complex solution. For me, if I was the FD or the CFO of this site, now I will be interested in taking this process forward because these returns on investments are very, very sound. A payback of 5 years, a positive MPV, a very healthy internal rate of return. These KPIs would stack up well against another project. But, another way of looking at this is, just supposing this business was making a contribution towards overheads, let's say a 50%, essentially a 50% gross margin. I think most folk would be jumping at the opportunity to take an investment of 260,000 to generate recurring revenues of, say, 120,000 for the next 20 years, for instance. It would make complete sense. But that's not the end of the story. The government subsidies that we used to take reliance on, such as the feed-in tariff and the non-domestic renewable heat incentive, they ended in March 2019 and March 21 respectively. But there is still support for the investment of low carbon technologies, specifically now for ground source heat pumps. So in this particular case, because this capacity is less than 45 kilowatts, there is a £6,000 boiler upgrade scheme, which can be accessed by the installer. So that reduces the cost by £6,000. And also, there is a corporation tax super deduction. And this is available until the 31st of March 2023. So this is a 130% capital allowance deduction. And it is, I believe, to be the most attractive tax incentive for businesses to invest ever offered by the British government. And that's according to HMRC. And to be absolutely clear, I am not qualified or authorised to provide tax advice. But what I can say is the super deduction does run alongside the annual investment allowance. It's also worth clarifying that rooftop PV will no longer impact the business rates of the business as it did do fairly recently. So solar PV, energy storage, other renewable technologies will be exempt from business rates from April 2022. That's a revised return on investment. We're looking at a payback of about 3.5 years. This is a material change from even last year, when energy prices were nowhere near as high, and despite the fact that renewable costs, installation costs have increased, these paybacks are half what they were 12 months, 18 months ago. So this leads on nicely into electric vehicles. The image on the left here is one I took a couple of weeks ago in Kilmarnock at the Halo Enterprise and Innovation Hub, which I think is a brilliant example of how a building can be powered by solar and wind, but in this particular case, including a solar carport that I took advantage of. The transport is actually the biggest proportion of UK emissions, according to BEIS, producing 27% of the UK's total emissions in 2019. Of this, the majority, 91%, came from road transport vehicles. And of that, 61% came from cars and taxis. So I took the plunge with an EV last year. Two reasons. Firstly, I think driving around in a Mercedes CLS is hardly on brand for Ongen. But actually, the second reason, the main reason, it just came down to straightforward financial calculation. Because once I'd got over the much overhyped range anxiety, in terms of decarbonising elements of an organisation, I think EVs are a really viable alternative to the internal combustion engine for, say, a fleet in terms of total cost of ownership, when you're factoring maybe slightly higher rental prices, but much lower maintenance, much lower fuel, and lower Class 1A national insurance contributions. I put together this little example for this webinar just to look at a single journey from Glasgow to London. And we can see there, just on one journey, there's a £40 difference in the cost of fuel. And that's being really quite conservative in terms of what I'm using for the cost of electricity. 30 pence per kilowatt hour is not cheap. And, if we've got, like I have, got solar PV at home, for instance, that marginal cost of electricity can come down to zero. The added benefit is, from an employee's perspective, is there's no vehicle excise duty, and the Class 1A National Insurance benefit in kind is only 2% currently, and that has been fixed until 2025. And you compare that to a vehicle that is generating 170 grams of CO2 per kilometre, the benefit in kind rate is a staggering 37% of the list price. So it's a huge benefit. In these calculations, I've ignored the London congestion zone, which is £15 a day. And there are 4 other cities that are going to be rolling out low emission zones imminently, including where we are in Edinburgh. I've got to mention greenwashing because it's a particular bugbear of mine and has been for a long time. And despite many protestations from the likes of or to Ofgem from Good Energy and Ecotricity, and including myself, the ability to greenwash electricity generated from fossil fuels, I think, it's still a practice, and I think it should be stopped. The problem we have here is renewable energy certificates of origin, REGOs. And these are certificates that are used to prove the fuel mix of a supplier. The problem is these certificates can be traded, and they are exchanging hands for barely a few pounds per megawatt hour. They used to be almost insignificant. There is value now, but it's such a small, a low value. And to be really clear, greenwashed electricity is not green energy, and it might fool some customers, but it's poor behavior, and it's not helping us transition to green energy. Unless the electricity that is being generated is coming from on site, it's coming from PV, wind, a CHP system, and I include a private wire in that. The electricity that's being used is whatever the fuel mix at the point in time, which will largely come from gas. Probably today there's plenty of solar and there's plenty of wind usually, but greenwashing is a very poor way, I think, of pretending to be green when you're not. And I think Ofgem should be acting on this. There's actually even a differentiation between the quality of REGOs. You get pure green REGOs, which comes from solar, wind and hydro, and less green REGOs, which come from, say, waste incineration. Just to be clear, this is about marketing. I must give thanks to Regen for allowing me to republish this. They're very useful infographic as part of this webinar. I'm going to touch on carbon offsetting very briefly. There are people far better qualified to talk about what is quite a complex subject. From one perspective, I would say it's a pity that we need to have a carbon market, but the reality is we do need one. We've spoken about gas. Gas is going away, nowhere fast, and so we do need to have some method of allowing organisations to become green, in inverted commas. I remember listening to a webinar at COP26 where it was likened to carbon offsetting was likened to paying the speeding fine after you've been caught speeding. Clearly, the ideal is that you don't get caught in the first place. So what is stopping companies from at least investigating which options are open to them to reduce greenhouse gas emissions and reduce energy costs? We launched a survey all the way back in 2016 when we kind of launched the first version of Ongen Expert, and asking this very question. I think it's still on the website somewhere. And when I look back at it, the results were in this order. First of all, it was the cost of implementation. There was a lack of funding. There was a lack of understanding of the technologies. There was a lack of internal resource to understand how to begin the process, and there wasn't enough staff engagement. I don't believe these reasons have changed dramatically. I still think these are valid reasons, and ultimately, this is why Ongen exists. I'll touch on Ongen Expert just very quickly, because Ongen Expert is a tool that we have developed to take all that data that we have talked about in this presentation. So we're looking at taking half-hourly consumption data, taking generation data, and ultimately coming up with a completely objective view of which technologies and maybe what combination of technologies can be assessed in a particular property to understand what the return in investment is. But, just to reinforce, we don't focus just on solar PV. We're looking at a range of 10 different technologies. So I'm aware that there are other topics I could have included today. Corporate PPAs, these are corporate power purchase agreements, with a whole raft of climate-related accounting disclosures that are coming through, and also how do we fund these projects. And these are all good subjects in their own right for future webinars, so watch this space. I'll thank you for listening. If anybody would like a copy of the Ongen guide or a copy of these slides, please just drop me an email, and hopefully we have some time to answer some questions. So what I can see here, Emma has asked, where would a client be able to find half-hourly data or gas smart meter data? So this is quite a common question. So thank you. Half-hourly data is owned by that property. So again, going back to the MPAN, if the meter is providing half-hourly data, it does exist, and it is the property owner's data to use. It should, in theory, come from the supplier. There are plenty of sort of energy management systems that provide a portal for this information to be downloaded, usually in Excel in a matrix format, or it can, under a suitable letter of authority, it can be pulled down, say by Ongen, if we are provided with the permission, from the industry directly. So there are many ways. So Alexon, obviously they're the balancing and settlement company. A company called Electrolink will collate, and they manage the data network. Gas will come from a company called ExoServe. Another question, I've not touched upon the intermittency issues of renewables. Any comments from a finance professional's perspective? Yeah, I mean, I think I sort of touched on it earlier. The intermittency is an issue, and I think it's when you need to start looking at a hybrid system, because solar PV is fantastic. Solar PV, as we speak, is powering this presentation from the solar panels that I've got installed. If I was doing this at 8 o'clock at night, probably wouldn't be that useful, or certainly in the winter, solar PV is not going to help me unless I've got a battery in place that could have been used to store that electricity. So I think it's a very good point. Intermittency is an issue. I think that there isn't one technology that's going to fix our net zero problem. There's not one technology that's going to work for every single property building in the UK or further afield. So it's about important to understand, again, looking at that consumption profile and then understanding which technology can meet demand at certain times of the day. But I think battery storage has got a massive part to play. Another question, what would your advice be for clients that lease individuals' floors and they want to reduce CO2 impact? So this is a really good question. Leasing can be a problem, because certainly when we were sort of pre-Ongen and in the early stages of Ongen, leasing was often seen as a reason why we would do, or a company would do nothing with their buildings, because it wasn't their building to do anything with. I think in reality what's happening, and I think increasingly, landlords, asset managers are getting on board with, actually it's really good economic sense for themselves to install renewable measures. So there's nothing stopping a landlord installing solar PV and selling that power back to its tenants, for instance. I think that's a really sensible solution. So I think there's definitely a perception that if you're leasing a property, and if it's a short-term lease, I totally get the point. You may not get the payback quickly enough, but I think we work with some quite large asset management companies, and we are definitely seeing a shift towards installing on-site renewables in particular. I didn't touch on this earlier in any great detail. We also look at on-site on efficiency. On efficiency is a platform we use to help identify energy conservation measures. So, if you're looking at what can you do, the first thing you should do is look at energy efficiency, probably. So there's probably a lot you can do, even if you've got a leased building. There's got quite a few questions coming through. What I will do is I will answer the questions that are coming through just now separately. I'll take them offline, if that's okay. Thank you again for listening, and please look out for future webinars.